Hello, everybody, and welcome to our last webinar of the calendar year. I'd like to thank everybody for taking the time, not just with this webinar, but with all our webinars we've held. I had a look this morning, and since COVID started, we've hosted 33 webinars since that time. So this is our 33rd since COVID started. And clearly, it's something that people enjoy and will continue to do in the new year. But for the last webinar for this year, Paul McEnroth is going to tell us all about structure choices for new business entities and try to settle the age-old debate of company versus trust. I'm not sure whether he will settle it, but he'll give his current views on it, no doubt. And so for those that don't know Paul, he's one of the principals of Cleary Hall. He's based in Brisbane and works predominantly with clients in Brisbane and the Gold Coast, as well as North Queensland. And he is, without further ado, he's going to tell us, I should point out a couple of things with the system to begin with. Over on the right-hand side of your screen, you'll see a chat button. If you want to ask a question either before or at the end of the presentation, just fire the question in and I'll interrupt Paul at an appropriate time. We'll also be having some time at the end to answer any questions that come through then. So Paul will also be running a couple of polls during his presentation. So he'll be asking some questions and some responses. It's great if you can complete those when he does that, and you'll be given time to do that as well. This webinar will be recorded and will be put on our website at a later date. So just bear that in mind in terms of any of the questions. Clearly, we'll edit them if you accidentally put in client details. But the webinar is recorded and posted on our website later. You also, on your right-hand side, you'll see a slides button. So if you wanted to download the slides from today, you can access them there. We'll also be providing them to you in our feedback email as an attachment there. Files button, I should say, rather than slides. So after that false start, in terms of trying to get Paul to start talking, I shall now hand over to Paul for him to start.
Yeah, thanks, Adrian. I think you're obviously very keen to get to the end of the year, as I think everyone is. But it is good that so many of you could attend. There's a fairly good roll up for the first week of December with less than I guess a week and a half to go. But thank you everyone for coming. So today, yes, I'm going to try to answer the age-old question of which structure should I choose to operate a new business. Back in 2017, at one of our LRC workshops around the country, I presented a paper on what we called then, and we had called previously when we used it at earlier seminars, the Cleary Hall Structure Wizard. And what that wizard was about was essentially a giant flowchart with a number of questions that would hopefully get you to the right type of entity to structure a business. Really interestingly is that pretty much all roads led to some form of trust back in 2017. And I did a little bit of a straw poll around the office just to get everyone's feel on, well, where do we currently sit now in terms of what we would be recommending? And somewhat surprisingly, that we as a firm have kind of changed our view that all roads lead to a trust, and predominantly most people were recommending companies. Now, no lawyer ever gives a straight answer. I'm pretty sure that's a given, but there's always little caveats that we throw in. The old lawyer line of, well, it depends, did get thrown at me a few times, but we certainly are leaning towards companies, whereas I think even a year ago I would have said absolutely not. But we're going to talk, I guess, about why we as a firm, or at least the individual practitioners, have started to lean towards a company as opposed to a trust structure. So what we're going to talk about is that age-old battle between trusts and companies, and really look at some of the pros and cons. And ultimately, we're going to look at the end of a business life planning, so end of life planning for our business. I should say that when we're talking about this question of company and trust today, it is in relation to businesses as opposed to other types of assets, passive assets. So in a passive asset owning entity, I would still recommend a trust of some sort. Again, it depends on the type of asset, and also funding is in large measure, and I'll talk a little bit about this later. Funding is an important aspect as to how do we fund the purchase of that asset and where does our money come from. If the money is coming from a bank, then a trust structure is for those passive assets perfectly acceptable and legitimate. But where there's going to be inter-entity loans, if it's coming from a company, we know that Division 7A applies. If it's going to be leased to our company, well, we need to make sure that we don't fall afoul of Division 7A and add extra layers of complication by having a trust in the mix. So when I say it depends, it does depend, and it needs kind of a bit more in-depth look at that time. But for today's purposes, we're talking about my new business that we're going to operate in the new year. So first, we're going to start just with a little poll. And I just want, I'll throw it up on the screen, but essentially a new client walks into your office. They're starting a new business, installing video conferencing and webinar equipment. Probably a little bit late to that game, but perhaps we went back a little while ago, a couple of years ago before COVID happened, and at the beginning of COVID, that would have been a really great business to be in. These people have been in the industry, and they're now going out on their own. They're going to bring across 5 staff, and the client you're talking to considers that some of them might become future owners. So I'm going to throw the poll up, and I'll leave it run for a while. But essentially, what would you recommend to these clients? A discretionary trust with them as the trustee, discretionary trust with a corporate trustee, a company with individual shareholders, a company with trustee shareholders, or a unit trust or a hybrid unit trust. So I'll leave that question open for a little while. If you can, I think it's on. Adrian, jump in if it's not on. But yeah, essentially, if you can roll through those, and I'll keep talking. We'll come back to the answers. So when we look at what the influence on our structure choice, the first one on the screen there, Division 115, or the discount capital gain, has for a very long time been the dominant factor in structure choice. We know that trusts or individuals have access to the discount capital gain, which allows any capital gain to be reduced immediately by 50%. And companies, as we know, don't have access to that capital gain. So that has, in large part, when we're, I guess, looking forward to the last bullet point, well, what's our exit strategy? That first point has been one of those really significant features, and probably the dominant reason why people have chosen trusts over time. Taxation is usually, front of mind for most taxpayers, and in recent years we've seen the advent of a lower corporate tax rate, small business tax rate, and as that's, I guess, become lower and lower, there's been a need or a desire on behalf of clients to have access to that. There can be some really strange anomalies with that tax rate, however, which we're going to talk about today, and it is designed for that to create those tax anomalies, but it does have. There are different taxation outcomes depending on your structure choice. Flexibility to evolve with the business, with business interests and ownership is another key factor as to what structure we might choose. Business profitability, either in the short term or the longer term. Funding, borrowing, and working capital requirements are important. Asset protection is always important. I would say it's probably lower down the line when people are starting a business. Most people who start a business don't have asset protection front of mind. They are concerned with getting their business off the ground. It's not until some years later that when the business is somewhat profitable that they might then come to the realization that, well, all my eggs are in one basket. What happens if that basket springs a leak, to mix many metaphors into one? And then ultimately exit strategy. How do I sell this business, and what is the outcome of that sale? So one of the areas that has for a number of years seen an evolving landscape is the taxation of trust income. And to be honest, this area is probably caused maybe somewhat equally with the taxation rates for companies. This has caused the drive towards companies. So the complexity around taxation of trust income. So as we know, trustees generally don't pay tax. They distribute their income to beneficiaries who include that income in their taxable income for the year, and those beneficiaries pay tax at their marginal rate. Bamford's case in 2010 went through the High Court and caused a fairly. I wasn't a lawyer at the time, so its impact I didn't see firsthand. But I'm told that at the time it was a fairly seismic shift in the industry. All of you would have had a million lawyers telling you that all trustees need to be updated to reflect this important case called Bamford's, and it was an important case. And it really, for want of a better description, it showed the complexities around trust law income and tax law income. And the case was really on 2 points. The first being in Section 95, what is the definition of income of a trust estate, and how does that contrast with the words later in that section being the net income of a trust estate? So from that case, we found out that income of a trust estate is the income according to trust law concepts. So a beneficiary would be entitled to the income according to trust law concepts, and then they pay tax on their proportion of that trust law income. They pay tax on the net income, and I probably that sounded more confusing than it should have. Essentially, you work out what's my entitlement to trust income, and then I apply that proportion or percentage, for want of a better phrase, to what the net income of that trust is for tax purposes. So those two amounts are not necessarily, and probably in most cases, not going to be the same. So your net income for trust purposes might be $700,000 in a given year, whereas the net income for tax purposes might be $1 million. If my entitlement is to 100% of that trust income, will I pay tax on 100% of the tax law net income? Again, probably in my explanation, it shows you that it is a complex area and difficult to explain to clients. They don't necessarily understand, well, I only received, according to the financials, $700,000 in trust income, but I'm paying tax on $1 million. Why does that make? That doesn't make sense. Obviously, none of you would probably set up a situation where they pay tax on the million. You'd probably use corporate entities and things like that. But using that as an example, it's difficult for clients to understand why they're paying tax on money they haven't received. The second part of Bamford's case was talking about whether the proportionate or quantum approach should apply to taxation of trusts. We know that the proportionate method was, I guess, the method that is used. What that means is that if there are 3 beneficiaries who each receive a percentage or proportion of the trust income, then they are taxed on the same proportion of the trust's net income for tax purposes. Where that applies is where you have a resolution that says Paul gets, $10,000, Megan gets $10,000, and the balance goes to a corporate entity. The quantum approach would see Paul and Megan remain as receiving only $10,000, and if the commissioner denied a deduction, for example, that extra income would go to the corporate entity. Well, that approach was rejected by the High Court. Ultimately, what came from Bamford's case was a set of streaming rules in relation to capital gains and also franking credits. And what those streaming rules are really about is saying that the full financial benefit of a capital gain needs to go to the beneficiary who's getting taxed. You can't send only the income and not a capital amount to the beneficiary who's paying tax. So when we distribute, say, net capital gain that the trustee has applied the discount capital gain to, well, the beneficiary who's going to receive that capital gain needs to receive the income amount and also the discount amount as well. Franking credits, in a similar way to capital gains, well, the person who gets the income from the dividend also needs to receive the benefit of those franking credits. Then I guess the changes to trust law income that came in with TR 2010-3 and the associated practice statement around Division 7A, while they're not changes to the law, they're changes to the administrative practice of the ATO. It caused a shift, and most accountants and clients will make sure they fit within the confines of those documents. So again, that adds another layer of complexity where a distribution to a corporate entity is treated as a loan in later years by the corporate entity to the trust. And you've got this round robin of money that clients don't understand. And we spend a lot of our time dealing with accountants and trying to solve Division 7A problems because clients don't understand why they're paying there's a dividend to them out of a company that does a round robin and ends up back in the same place. It's complicated, and we know obviously that there's been further flag changes to Division 7A. We don't know when they're coming or what they actually look like, but that will add further complexity to the changes to the taxation of trust income. Might jump in there and close off our little poll. So essentially, we've got 0% choosing discretionary trust with an individual trustee. Well done. Discretionary trust with a corporate trustee, 11%. Company with individual shareholders, 9%. A company with trustee shareholders, 76%, and a unit trust, 2%. It's probably in line with what I would have thought this poll would look like. Probably the one for me, the company with individual shareholders, we would never recommend that scenario, just from both a taxation flexibility for the shareholders and asset protection. But we see plenty of them around, and as long as the clients understand how that works and what the implications are, then okay. I'd probably agree with the group here. This is what I would recommend probably this year and going forward, for some of the reasons that will follow. So in terms of changes to taxation of companies, we know that a couple of years ago now, probably 4 years, maybe 5 even, maybe even longer, was the introduction of the base rate entity scheme. And we've marched all the way to the position where we are today at 25% for significant entities that have a turnover of $50 million or less. obviously there was a lot of debate and I guess haggling over the legislation, and originally that was going to apply to a bigger business than $50 million turnover, but that's where it landed. So it introduced that lower corporate rate for small businesses, and it did, the original scheme allowed a company to frank at a higher rate than their tax rate. So if you had franking credits built up in your company from the years where you were a 30% taxpayer, you could continue to frank at that rate in later years. When the second round of amendments to this legislation came through, that changed. So you now can only frank to the extent that your franking balance allows it, of course, but also to the extent of your tax rate in the current year. And it's based on the tax rate in the current year, based on your turnover in the last year, which is probably a little bit irrelevant now, that second part, now that we're at the highest end of entities for turnover test. But I guess as your turnover grows, that may be somewhat relevant. So there may be some years where if you're going to go over $50 million turnover this year, it might apply for a further year, but going forward, it may change your franking and tax rate. So this base rate entity scheme does create some strange outcomes when trying to extract retained profits from companies for asset protection purposes. So if we've got a system where we've got a discretionary or other type trust that is running our business, and we distribute that money to a corporate beneficiary, if we meet the other thresholds, then generally that company will pay tax at the lower rate of 25%. That is because the income that is received by that company will generally not be passive income. And there's obviously definitions around what that is, but for our purposes today, it won't be passive income. So it will be taxed at 25%, provided it's at least more than 20% of our income. Contrast that, though, with an operating company at the top here on the right. You've got an operating company that's owned by a shareholder trust. We pay a dividend from the operating company to the shareholder trust, who then distributes to a corporate beneficiary. Well, that corporate beneficiary is not in receipt. Well, sorry, it is in receipt of passive income, because it loses its flavour of being non-passive income by passing that dividend through the trust. A dividend is generally a passive income stream for the purposes of this section. So in this scenario, if we wanted to, for asset protection, pay a dividend from our operating company to the shareholder trust down to a corporate beneficiary, we might lend money back. That corporate beneficiary, in effect, or that group, in effect, loses the benefit of a lower tax rate, because ultimately the retained earnings have to be taxed at 30%. So that does create a bit of an anomaly in the system. Again, contrasting a unit trust structure. So if we had a unit trust that paid its income through its two unit holder discretionary trusts onto corporate beneficiaries, those corporate beneficiaries still are in receipt of non-passive income, and they would have the benefit of a lower corporate tax rate. Again, contrasting back with the earlier slide where we lose that lower corporate tax rate. One way we often, I guess, get advised to give advice on is asset protection. We might recommend this structure where a holding company be interposed between our operating company and the shareholders. In this case, we would pay a dividend from our operating company subsequent to the interposition. Our operating company is taxed at 25%, and our holding entity, again, is taxed at 25%. Obviously, there are that's not a perfect scenario because it doesn't give us a complete asset protection, because there is a section in the Corporations Act that allows a holding company to be liable for some debts of the operating company, where effectively where there is a joint board or similar board, and the holding company allows the operating company to trade whilst insolvent. If that happens, then the holding company can be liable. Those circumstances, it is a lower risk in our opinion, certainly a lower risk than leaving the retained earnings in our operating company. So, yeah, we get called in. I gave advice literally yesterday around this exact structure, albeit it was more than one shareholder, so we were recommending a different type of rollover. But in this scenario, we would use a Section 1 or Subdivision 122A rollover, where there's more than one shareholder. We might recommend a Division 615 rollover to bring that company in between. Obviously, the holding company can then either lend money back to operating company, or it can set up other subsidiaries and the like, or lend to other corporate entities. So I guess looking at the other, requirements of this client scenario, flexibility to evolve is important. Where we operate through a discretionary trust, it doesn't offer the flexibility to introduce new owners into that structure. Unless those new owners happen to be family, it is difficult. It kind of requires a partnership of that trust and another entity if they're not going to restructure. Obviously, we do get called to give advice in these exact structures, and usually the answer is, well, we're going to have to restructure the business out of the discretionary trust and into a company or some other entity, generally a company because there are tax rollovers, and then introduce that new party as a shareholder. If we're introducing people into our trust, for example, well, you got to look at family trust elections and things like that. Again, like I've said there, unless it's a family, it's not really an option. Unit trusts, one of the big inhibitors to, unit trust entry is stamp duty in Queensland and WA. Certainly in Queensland, the transfer of units or the introduction of new unit holders through an issue would be dutiable, particularly in the scenario of it operating a business and therefore having dutiable property. Having a company structure, flexibility to evolve is much simpler. It can either be done by an issue of shares or a transfer of shares. Generally, the difference between the two is, where do we want the money to go? So if that person is buying, does the money go to the existing shareholder as payment for their business, or is it working capital money put into the business? If it's working capital, then we would put that money into the company by an issue of shares. If the money for the entry is to go to the shareholder, then obviously we would do a share transfer. In those circumstances, we would recommend a shareholders agreement, because one of the issues, and we've spoken on it at other webinars, is introducing new owners, while a great idea for business growth and succession. Unfortunately, they don't always get along, and expectations do change. So having a good set of rules up front is very important.
Paul, while you have a break to take a glass of water, just a question on the previous example.
Yeah.
If the holding co is a passive company, is the dividend received from Operation Co taxed at 30%?
Good question. Sorry, I should have mentioned that. The reason it's not is because there is an exception in the passive entity rules for what's called a non-portfolio dividend. And a non-portfolio dividend is a dividend from one company to another where the other company has more than 10% voting rights. So in this scenario, we've got holding co owns 100% of operating co, therefore has 100% voting rights. So that dividend is a non-portfolio dividend, which is not passive income. So therefore, it is taxed at the same tax rate. Again, that is the complexity that the changes brought, but that structure allows that corporate tax rate to be the same rate.
Thanks, Paul. I think in the original iteration of the legislation, it was going to be that way, but that changed as it went through.
Yep. Okay. So I guess one of the next factors is looking at, profitability, funding, and working capital. Business profitability, obviously, the higher the profit, the higher the tax is going to be in a trust structure. Whereas in our company structure, where we cap that tax at 25%, then those differences do play out. Where it's a small business that operates on a low net profit, it might have enough for mum and dad to take $100,000 or $200,000 each. Well, the tax at that level is manageable. Once we get much higher than that, suddenly we introduce corporate entities to cap that tax at as low as possible. We might be able to cap it at 25% there. However, then we've got Division 7A because, as you all know, your clients don't always spend within their tax means. That is, they spend their $100,000 they've paid tax on. They usually take the money from the company. Suddenly you've got Division 7A loans. They then have to fund the round robin of payments in order to repay those loans. So the higher the business profitability, the harder it does become to manage those payments in a trust structure. Again, it's moving to a company is not the panacea to solve that problem of Division 7A, because as you know, the company might pay tax at 25%. They might pay the business owners a salary, but the business owners have spent extra money on school fees, other things. Those still have to be managed either through a dividend or through Division 7A loans. So there's still a level of complexity there, but I would argue that it is slightly easier to understand from a client's perspective of, you spent the business money on school fees. Well, that either has to be a dividend to you or some sort of loan that's repayable. That's a little simpler to understand than a trust structure or the trust and Division 7A. Funding and borrowing. I put this question out there to you. I probably deal with it less than you would, as to whether it's easier to borrow in a company or a trust. I probably don't know the answer. I think my gut feeling is a company will be simpler, but maybe not that much. The reason, and probably thinking about it from a completely different perspective, QBCC requirements, they prefer companies because at least they know that, all the income will generally be at least trapped in that entity. Banks may have a similar view. Well, money will be trapped in the company. It won't have to, or income won't have to flow through to other beneficiaries, and therefore be outside the reach of the bank. So perhaps it may be easier in a company. I'll leave that one to you. Working capital, obviously, we know that trusts distribute their income each year, so therefore there is a working capital drain. That's why Division 7A under TR 2010-3 becomes really relevant, because most of that money is either left in the business to fund that working capital, and in scenarios where that working capital is built in, either we don't get paid because it's a debtor, for example, or it's left in the business to build and grow the business. Well, we're paying tax on those paper profits, and that is obviously an issue for clients. Asset protection is, as I said probably at the beginning, is one of those things that people often think about later rather than early on. But when we're talking about asset protection, we want to separate the assets from the risk. So we try to keep assets in different entities. If we might have a asset owning entity that leases its plant and equipment to the operating entity, so that we can make sure that going forward our assets are separate from where we have trading risk. Holding company, we talked about that scenario where we might pay all of the retained earnings to our holding company. However, there is still some liability, albeit lower, where under the Corporations Act, that holding company can be liable. Again, shares or units held by the discretionary trust rather than the individuals, and that's, I guess, what I talked about as at the end of the poll result, as to why we would recommend in, I would say, all cases, that a trust hold the shares, because it gives our principals of the business that asset protection, that their activities outside the business are not going to affect their activities inside the business. So we might operate under these sorts of structures, where we have an operating company and an asset owning company, and we would have hire agreements between the two and make sure we register those hire agreements on the PPSR, or it may be a building. If we had a building in an asset owning company, I'll come back to that in a second. Well, at least we have a commercial lease agreement between the two. Again, happens exactly the same if we were going to operate in a trust structure. Where some extra care probably needs to be put in place is where you might have a trust that operates. I probably should have had that around the other way. I'm sorry. So say the company owns the business, a trust owns a commercial building, and we have a lease between the two. Where we need to be careful, obviously, is Division 7A. We make sure we have a lease at market value. We make sure that we cash flow any payments that are required to be made under the agreement, so that we don't fall afoul of Division 7A. One of the questions that we often have is how do we fund purchase of assets? Going back to this slide here, where we're going to fund assets, or how we're going to fund it. If we're going to fund it from an operating company, it becomes difficult to lend money from our operating company to a trust, because obviously we've got Division 7A compliance. A loan will be over 7 years at a fairly high interest rate at the moment. That will be even higher if the changes, when the changes are enacted. I think the rate under the proposed changes is somewhere in the order of about 8 or 9%. So that's relatively high in this low interest market. So owning a building, for example, in a company, while we don't get the discount gain and we will pay tax at 30%, the ability to fund it through loans, through other entities, I'm not suggesting through the operating entity, but other entities may be preferable. So it's about looking at it a bit more holistically than just, I guess, saying, well, all assets should be owned in a trust, all active or business assets should be owned in a company. It needs a little bit more holistic approach as to, well, how are we going to fund those assets? Where does the money actually come from, and what implications flow from that? One way we might fund, obviously, on this previous slide, is if we had an entity that had income, there might be a distribution of income to our asset owning company that can then use that money to fund the purchase. Likewise, on the other screen, our operating company, if that's where we're going to, I guess we're going to have an operating company, we might pay a dividend to our trust, who then distributes it to an asset owning company, for example. The tax on that would be 30%, because we're having a dividend. It's not a non-portfolio dividend. So our asset owning company would pay 30% on the dividend, but that may be the way to get our funds into that asset owning entity. End of life is, it's a bit of crystal ball gazing. We're looking, a mile down the road. We're trying to, at the beginning, in effect, guess what the outcome's going to be and how we might do it. We've done this forever. That's why we've chosen trusts over the long term as our entity to run businesses, because we wanted to get access to the discount capital gain and small business concessions in an easier way. It is simpler to use the small business concessions in a trust, because you do get the discount gain, and all of the gain can flow as a end of year resolution. Accessing the concessions in a company is more difficult, but that's not a reason to choose one over the other. The access is roughly the same. It is probably, you do get more concessions out of a trust. However, again, that's not necessarily the reason to choose a trust over a company. And we're going to talk about how those concessions do work in the different scenarios. So look, today's not about going through all of the concessions and how they work. We've done that in many other papers. You can see them on our website. There's webinars and things. We've got plenty of papers on that, and most of you will have been to those. But really recapping, we need to be a small business entity, which with our essentially satisfying the maximum asset test or the $2 million test, and what we're distributing or what the capital gain is on is in relation to an active asset. So really that's a very short snapshot of the concessions. But as I said, we've got plenty of other papers on that. We're just going to work through a couple of examples of the different types. So we've got a trust sale of a business, essentially a capital gain of $1.7 million with two significant individuals. So assuming we meet all of our concessions, there are a number of requirements that need to be met, but we're going to assume for today's purposes that we do meet them. So we've got a $1.7 million gain. Our cost base is nothing. Using the CGT discount, the active asset reduction, and our retirement exemption, even if we only had one significant individual, but in this case we've got two, we would be able to get our assessable capital gain down to zero. So, we've worked through this in greater detail on many other occasions, but essentially I would think that most of you who've listened to our papers would understand that where there's two individuals, a gain of $4 million, we can reduce that to zero. Obviously, using the retirement exemption for both our significant individuals, each of them would get $500,000 to be able to be put into superannuation. If they're over 55, if they're under 55, if they're over 55, they can keep that $500,000.
Before you move on, Paul, just a question on the example with the asset owning entities. Can an asset owning company be active for tax purposes, that is maintaining and leasing assets to the operating company?
Look, it can, but the Commission has some really widely varying views on whether it's running a business. In that scenario, I would suggest that the Commissioner would take the view that it's a passive entity because it's leasing a building to a related party. However, there's been audits we've done, Adrian. I think you had one where they suggested that 17 properties wasn't a business, which is ludicrous, but that was their position on that matter. I've seen ones where a couple of buildings was deemed to be a business. So unfortunately, there's no clear answer. I think in that scenario, the answer would be the Commissioner would take a view that it's not running a business and therefore is passive income. Although for the purposes of this test, rent is automatically deemed to be, the purposes of the corporate tax rate tests are not on sale. Purpose of the corporate tax rate test, rent is passive income. So there's probably two different questions there. Corporate tax rate, it's going to be 30% because rent is passive. If we're on a sale, it's looking at, well, is it an active asset? The commissioner would probably say no in that scenario.
Unsurprisingly, Paul, I take a different view. The follow on from that question from the same person is that what if it's machinery getting leased? I'll cover it off very quickly because I'm just bearing time in mind. There is a carve out in 152.40 sub 4E that says that if the main use of the asset is for deriving rent, it can't be an active asset. However, you still have to consider whether it's an asset that's used in the business. So in the scenario where we have, whether it's machinery or whether it's a building rented to a related party, the commissioner will still accept that as an active asset for the small business CGT purposes. And there is a tax determination 2006, the number escapes me for now, which confirms that. So even though there is that carve out that says passively held entities or passively held or rented assets can't be active assets, you still have to look at what the main use of it is. Is the main use of that machinery or that building in the business of that associated taxpayer? And if it is, then it's active. And that's all I'll say on that.
I guess you'll correct me again if I'm wrong, but I guess that's what Eichmann's case was all about. Was whether it was used in the business and whether the CGT concessions applied to it. Yeah,
effectively.
Yep. All right. So I guess taking the same facts as the previous example and applying it to a company, this company also has retained profits of 800,000. So if we look at the CGT position of the company selling the business, obviously we might get a position similar to the earlier slide if we sold shares, for example. But if the company sells the business, we don't get the CGT discount, and that has always been one of the downsides. In this case, active asset would be higher, and we would be able to apply $850,000 towards the retirement exemption. So in that case, the company still gets to a position where there is no assessable capital gain for the company. But what it gets to is a position where we've got money left in the company. So our 850 has been paid to the super fund, for example. We've still got money left in the company that has not been taxed in the company. How do we get that out? If we were to pay a dividend, we obviously have $800,000 in retained earnings, so we might be able to pay a dividend, but that certainly wouldn't get all of that money out of the company. If it did, there might be some tax to pay, there would be tax to pay in terms of top-up tax. We take a different approach. So obviously we're looking at, well, the untaxed portion is 850. And if we took that out effectively, there would be tax payable. If we wind up the company as an alternative, there's an old case called Archer Brothers, and effectively the principle that it was at a time pre-CGT, but the introduction of CGT doesn't affect the principle of the case, it just affects the taxation of it. So the principle that came from Archer's case, from the Archer Brother case, was that a liquidator may, by a proper system of bookkeeping, keep the accounts to be able to make or appropriate particular distributions out of or to particular profits. Amounts appropriated will represent the profits out of which the appropriation is made. Now, that's a horrible way of saying, if the accounts reflect that $850,000 is referable to the small business 50 reduction, that is a capital amount, and when the liquidator pays that distribution, it takes the 850 that is paid to the shareholders, and it debits it from that account in the books. Then that amount will go to those shareholders as a capital profit referable to CGT event C2. So it won't be a dividend from the company. There is a carve out in section 47A, capital A, that says it won't be a dividend in that case. It will go to the taxpayer as a capital amount referable to CGT event C2. What that then means is the shareholder has made a capital gain in relation to their shares. They've been paid that amount that has come to them. I've slightly changed the figure. Rather than paying the full amount of 825, I've changed it to be 600, just because what that does is it works out that our shareholders, when you get down to our retirement exemption, it brings them up to the full amount they can put into their superannuation of 500,000 each. So in this case, we might pay a dividend of 275, and we've got a capital gain of 600,000. We get to we're treating a nil cost base. We get to apply the CGT discount in relation to our shares. We also get the active asset reduction, or the small business 50 of 150,000, and we then put money into our superannuation for the retirement exemption. And this is all in relation to our shares being cancelled through the wind up. So again, we've got 600,000 of our 875,000 out tax free. There will be obviously some top-up tax to be paid on that franked dividend, but the top-up tax is fairly nominal in this case. So our end result, we get $500,000 as a, I guess, automatic deposit to our superannuation if we're under 55. If we're over 55, then it can go straight to the individuals. We get a balance of $450 tax-free to the shareholder, and we get a fully franked dividend of $250,000.
Just before you start, well, I'll start the poll for you since you had your technical issues last time. Just a question on comments in relation to Archer Brothers. In the financial statements, would this be recognised through the use of a capital profits reserve?
Yeah. So that's exactly how it usually is crafted, is a capital profits reserve. And when we obviously instruct a liquidator, we make sure that they're aware that the dividend or the payment needs to be debited from that. Most liquidators are on board to that. They understand how it works, and I guess are aware that that will be the most tax effective outcome for the shareholders.
Thanks, Paul. And just to let you know, the poll is live.
Yeah, so the poll really is, has your opinion changed? Options are yes, I would now choose a trust. Yes, I'd now choose a company. No, I'd stay with the trust, or no, I'd stay with the company. So I might open the floor to any more questions while that poll's still rolling through. I'll probably end with the final comment that, I think I've fairly clearly articulated that I would lean more heavily towards a company. I would say that I've only really come to that proposition very recently, inside the last 6 to 8 months. Before then, I would have said a company every day of the week. A trust every day of the week. Trusts certainly have their uses and are still going to be broadly used. But for this scenario where they're operating a business, I think it provides the clients with a simpler structure to understand, an easier access to the corporate tax rate, and generally less tax issues down the line.
A couple of questions. First one, Warren, I'm thinking Paul means the poll and whether he's convinced you during this webinar.
Yeah.
Question, Paul, if a holding company owned the shares in the trading company that has sold the business, how would you get the active asset component out of the holding company?
Out of the holding company? Well, yeah, it's a very good question. I've never turned my mind to it. So the active asset is in the original company. I guess that would have to come, it would come to the company as a capital profit in the same way. They wouldn't access the discount gain, but they would still have a CGT event. So the process would still work itself through. There might be more tax payable depending on what might be left. There is still a significant individual that you can pay money to a super fund, and there is a look-through process for that. It would just be in that first instance, there is no discount capital gain as there is for that trust shareholder or individual shareholder in the other scenario. You might need to liquidate the holding company as well in order to get out the balance of any money or any untaxed portion that is left in the holding company.
Yeah. Or perhaps part of the discussion could be, if possible, do we sell the shares in the holding company as the transaction as opposed to assets of the business? Yeah. Can the sale of business premises where the business is conducted be considered as an active asset under the small business CGT concessions? The business continues to be conducted at the premise.
Well, I think that was kind of your point before, Adrian, that if it is used in the business of the related or connected or affiliated entity, then it should have the CGT concessions applicable to it.
Yeah, or the taxpayer itself if they're the taxpayer. Just while we wait for any further queries, housekeeping for the end of the presentation. Thank you for coming along today, wherever you've tuned in. Thank you for your support over the last year and attending these webinars. For the people that have been to a few, it's very much appreciated. We will be restarting in February sometime, I would say. You'll receive the normal notification in relation to that. At the end of the presentation, you will receive a feedback email with a very short survey on it. We do appreciate you taking the time to complete that. And I'll take the opportunity now to thank Paul for the presentation.
Thank you.
And I think we close it off and wish everyone a very good Christmas break when they get to it.
I'll probably just let everyone know the poll result. So yes, I would now choose a trust. So I've actually turned people off my central premise. So has your opinion changed? Yes, I would now choose a trust 7%. Yes, I would now choose a company 15%. So I'll take that as a win. No, I would stay with the trust 10%. I'm comfortable with that answer as well. No, I would stay with the company 66%. So yeah, thank you everyone for contributing, and yeah, have a great Christmas, everyone. Really look forward to catching up with everyone in the new year.